In January 1980, silver hit $50 an ounce. $50. People thought they'd figured it out. They thought they'd found the thing that would protect them from everything falling apart. Some bought at $40 expecting it to double to $80. Some leveraged money they didn't have. They were convinced the dollar was finished and silver was real money, real wealth that couldn't be printed away. 2 months later, in March of that same year, silver crashed to $10.80. In 8 weeks, people who thought they were getting rich watched it lose 78% of its value. And here's what matters for today. The exact same pattern happened again in 2011. And it's happening again right now. This isn't a prediction. This is history. And understanding why this pattern keeps repeating tells you something important about how people make financial decisions when they raise scared. Let's go back to the 1970s. The 70s were a strange time in America. The dollar was breaking. You could feel it. In 1971, President Nixon did something that shocked the world. He closed the gold window. For the first time since 1944, you couldn't exchange dollars for gold at the Federal Reserve. The promise was broken. If you were paying attention, and a lot of wealthy people were, you understood what it meant. The government couldn't back its currency anymore. The money supply was expanding. The dollar was losing value. Then came the oil crisis in 1973. OPEC embargoed oil to the West. Overnight, gas lines stretched around the block. People sat in their cars for hours hoping to get fuel. Inflation was climbing. By 1975, a new car that cost $5,000 2 years earlier now cost $8,000. Housing prices were jumping 30–40% a year. Not in hot markets, everywhere. But wages weren't keeping up. A factory worker who made $15,000 a year in 1972 was making about $17,000 by 1975. He got a 3% raise while his house doubled in value, and his grocery bill jumped every month. He could feel his money losing power. Every month it bought less. Every month his purchasing power shrank. So what did people do? Some bought gold. Some bought real estate. But a lot of smart people, actually smart, not just confident, started looking at silver. Silver wasn't theoretical. It was real. You could hold it. It couldn't be printed by the Federal Reserve. Throughout history, in every currency crisis, and every time the government currency fell apart, silver went up. Spanish Empire, silver. Weimar Germany, gold and silver went through the roof. People who held silver survived. People who held currency got wiped out. That wasn't crazy thinking. That was historical pattern recognition. And a particular family in Texas was paying very close attention to those patterns. Nelson and William Hunt were brothers. Their father had been one of the richest men in America. Oil money, the kind of wealth that compounds. When their father died in 1974, the Hunt brothers inherited $5 billion. Yes, billion with a B. Nelson Hunt was an unusual man. He thought the dollar was going to collapse. He really believed it, not in an abstract way. He'd studied economic history. He'd watched governments default. He'd seen currencies destroyed. And he believed the same thing was coming to America. The deficit was growing. The money supply was expanding. The only protection was physical assets, real things. Governments couldn't print. By the mid-70s, Nelson started buying silver, not coins, industrial silver, large quantities. He wasn't alone. There were others doing the same thing, but he had a specific advantage. He had $5 billion and he had conviction. Here's how the mechanism worked. Silver was traded on the COMEX exchange in Newark. When you want to buy a large quantity, you typically can't just show up with cash. You borrow money. You put up a certain percentage as margin, let's say. You need to put up 20% of the purchase price to control 80% through borrowed money. This is leverage. It's how it works in commodities trading. Nelson started buying. As he bought more, the price naturally went up. Supply and demand. Less silver available at lower prices. So people had to bid higher to buy. As the price went up, it attracted other buyers. They saw silver going up and thought, I should get some too. This created more demand. More demand pushed prices higher. The hunt buying was creating a feedback loop. By 1979, the hunts had accumulated enormous quantities of silver. Estimates vary, some say 100 million ounces, some say to 150 million ounces. Whatever the precise number, it was massive. They'd accumulated roughly 2% of all investable silver in the world. The legend that they held 1/3 of the world's silver is false. But their 2% was still enormous in a market where large players rarely accumulate that much. The price climbed from $6 an ounce in 1979 to $40 by December, then $45. Then it kept going. By January 18, 1980, silver hit $49.45 per ounce, not about 50. $49.45, specific number, because it was the peak. People thought it was going to 100, maybe to 100. This was going to be the investment. That made them rich. Here's what nobody counted on. The COMEX exchange had rules about how much leverage you could use. And in January of 1980, they got nervous. They could see what was happening. They saw the hunts accumulating. They saw new buyers jumping in. They saw a bubble forming. They were worried the whole thing would collapse and default, which would destroy the exchange itself. So on January 7th, 1980, they changed the rules. They raised the margin requirement. Instead of putting down 20% to control 80%, now you had to put down 50% or more. This meant if you were a leverage buyer, your margin call was immediate. You had to come up with a lot of cash right now, or your position was forced to be sold. At the same time, Paul Volcker, the Federal Reserve Chairman, was tightening credit. He wanted to squeeze inflation out of the economy, so speculative credit was being restricted. The money that had been flowing into silver speculation dried up overnight. On March 27th, 1980, they call it Silver Thursday, the price collapsed. It fell 78% in weeks, $49 to $10.80. The hunts had accumulated to 150 million ounces at an average cost of around $5 to $7 an ounce. They were sitting on enormous paper gains, but they'd also leveraged heavily. When the margin call came, they couldn't sell into a falling market that would lock in the losses. They couldn't hold, they'd be forced to sell anyway, so they had to take the losses. They realized about $1.7 billion in losses. Their wealth dropped from about $5 billion to less than $1 billion within a few years. They also got sued. They got charged with manipulation by the Commodity Futures Trading Commission. They paid over $130 million in fines and settlements. They were banned from commodity trading. It's important to understand, they weren't trying to be villains. They were trying to protect their family as wealth from what they genuinely believed was an inevitable dollar collapse. They had a rational thesis. They just had one problem. They were wrong about the timing and wrong about how the market would move, and they paid a historic price for it. Let me give you the timeline in specific numbers because this is important. The setup 1970s, 1971, Nixon closes the gold window. Dollar is no longer backed by gold. 1973, OPEC oil embargo. Gas goes from 36 cents a gallon to 55 cents in months. 1975, inflation hits 9.2%. New car prices jump 30% year over year. Housing prices rising 40% annually in some markets. 1977, silver trading at $4 an ounce. Most people aren't paying attention. The accumulation 1978-1979, late 1977. Hunts start buying. Initial purchases attract little attention. 1978, silver climbs from $5 to $8 per ounce. Hunts buying accelerates. Other wealthy investors notice and start buying. Mid-1979, silver hits $12 per ounce. Speculation picks up. Retail investors start buying silver, coins and small bars. December 1979, silver hits $34 per ounce. Now everyone's paying attention. The peak January 1980, January 14th. 1980, silver hits $49.15, January 18th. 1980, the actual peak, silver reaches $49.45 per ounce. Price has increased 824% in 12 months. Hunt's accumulated position is worth approximately $12 to $15 billion on paper, based on estimates of 150 to 250 million ounces at peak prices. The collapse March 1980, March 27th. 1980 silver Thursday. Silver drops to $10.80 per ounce. In 8 trading weeks, the price loses 78%. Hunts face forced selling on margin calls. Bank loans are called. They have to sell regardless of price. Estimated losses, $1.7 billion. Some sources say up to 2-point-something billion. Additional impact, Peruvian silver mining company sues for business destruction. Wins $130 million judgment. The regulatory response, CFTC charges the Hunts with market manipulation. Fines and settlements total over $130 million spread across multiple charges. Hunts banned from commodity trading for several years. The long-term impact on the Hunts, 1980. Estimated net worth $5 to $6 billion. Inherited wealth, oil interests. Diversified holdings, 1981. Net worth approximately $2 billion after losses and forced asset sales. 1988. Estimated net worth under $1 billion. Wealth declined 80% in 8 years. They recovered somewhat over time with real estate and oil interests, but never regained the scale of wealth from 1980. The broader silver market post-1980. 1981. Silver settles around $10 to $12 per ounce. Stays depressed for years. 1985. Silver around $6 per ounce. 1990. Silver around $5 per ounce. It takes 15 years for silver to approach its 1980 peak again. Now here's the important part. This wasn't unique to 1980. The pattern repeated. The 2008 to 2011 repeat. In 2008, the financial system collapsed. Bank failures. Housing crisis. People panicked. They did exactly what people did in 1973. They bought silver. October 1988, silver at $9 per ounce during the crash. 2009, silver climbs from $9 to $18 in 12 months. 2010, silver continues climbing from $18 to $30 per ounce. April 2011, silver peaks at $48.46 per ounce, essentially the same peak as 1980. 2012, silver crashes back to $26 per ounce. Another 70% drop, different generation. 2015, silver slides to $14 per ounce. 2016, silver around $15 per ounce. People who bought silver at $40 in 2011 expecting it to double or triple, they lost money if they held. Long term, anyone who bought at the peak and sold at the low lost 70%. Anyone who held from 2011 until 2016 made nothing, but watched their money sit still for 5 years while they could have been in other investments. The current situation 2024, early 2020, silver around $15 per ounce. 2021, silver rallies to $26. 2022, silver falls back to $18. 2023, silver drifts between $18 and $20. Early 2024, silver around $24 per ounce. Mid-2024, silver reaches $31 per ounce. Current, silver hovering around $30 per ounce. So silver is at $30 right now. That's up from $24 at the start of the year. But here is what it has not. It has still 36% below the 1980 peak of $49.45. It's still 37% below the 2011 peak of $48.46. And yet, if you go online right now, you'll find content creators, commentators, and silver advocates saying that silver is going to $50, $60, $70, $100. They say it's undervalued. They say this is your last chance to buy before it explodes. They're saying exactly what people said in 1980 and in 2011. The data sources, COMEX historical pricing confirmed across APMEX, JM Bullion, and macro trends. Net, CFTC enforcement records publicly available. Hunt family wealth estimates from Family Office data, Forbes, and Wall Street Journal archives. Federal Reserve historical interest rate data, and Bureau of Labor Statistics inflation data.
Numbers are interesting, but they're abstract. Let me show you what this actually meant for people. Let's start with the Hunts themselves. Nelson Hunt was 64 years old when silver collapsed. He'd spent his entire adult life as a billionaire. He'd inherited generational wealth. He was the elder statesman of a major family, Indian. In the course of months, a significant portion of his wealth evaporated. Not because he was stupid. He was highly educated. Not because he was lazy. He was actively managing his investments. He was wrong about the timing of currency collapse and wrong about how markets would move. And the cost of being wrong was losing 80% of his net worth. But the Hunts could absorb that. They still had $1 billion. Most people can't absorb an 80% loss. Here's a story that played out 1,000,000 times smaller, but much more painfully. A factory worker in Pennsylvania makes $50,000 a year. It's 1979. His kids are in school. His wife works part-time. They've got a modest house, a car that runs, and they're stable but not wealthy. But he's worried about what he reads in the news. Inflation. Currency collapse. He's got his wife convinced. They liquidate their savings. They take out a small loan. They buy 2,000 ounces of silver at $35 per ounce. They're putting in $70,000. This is conservative compared to the leverage some people used. They're convinced. The older guys who own silver got rich. This is their chance. Then March comes. Silver collapses. Here's 2,000 ounces are worth $21,000. He's lost $49,000. Not on paper. Real loss. Real debt to repay. He can't sell and realize the loss because that means admitting the mistake to his wife. He can't hold because he needs the cash. He has to sell into the crash. He realizes the loss. His house is still mortgaged. Now he's got a debt from the loan he took to buy silver. He's got mortgage debt. He's got consumer debt. His wife has to go back to full-time work. His kids might not go to college. That scenario, magnified across thousands of people, is what happened. The Peruvian silver mining company that sued the Hunts, the company was destroyed. The disruption in the market made it impossible for them to operate. Employees lost jobs. Communities that depended on the mining operations lost income. And here's the deeper human consequence. The Hunts experience created a template. Hearty. After 1980, safe haven investing during crises became a thing. A pattern people could identify with and repeat. Whenever currency fears spike, whenever inflation climbs, whenever recession comes. A segment of the population thinks, silver. 2008 comes. Financial crises. Banking collapse. People look at their retirement accounts and see them cut in half. They're terrified. They buy silver. They're not stupid. They're terrified. They're trying to protect themselves. They're following a historical pattern they think they understand. And this is the thing that keeps happening. Crises don't resolve the way they expect. The Fed steps in. Credit markets stabilize. Confidence returns. Safe haven, that was supposed to protect them, becomes a burden they're carrying. Everyone who bought at the peak needs to sell eventually. When they do, prices fall. That's not conspiracy. That's supply and demand. Everyone holding wants to unload. Not many people want to buy at those prices. So prices fall. The people who bought silver at $40 in 2011 could be sold at $40 in 2011. They didn't. They held, convinced it would go higher. By 2012, it was $26. They sold at $30 in 2013. They still lost 25%. Some held longer. Some are still holding. And some of those people, even after that experience, are buying again in 2024, convinced this time is different. That silver will finally explode. That all the rules have changed. This isn't about judgment. This is about pattern. When people are scared, they make decisions they think are logical. But fear and logic aren't the same thing.
Now, I'm not saying you should never own silver. I'm not saying safe haven investing is always wrong. What I'm saying is, this pattern of panic buying gives price spikes, gives crashes is repeated. And there's something about it worth understanding. So what did people do who didn't lose money in this pattern? What was the different approach? First approach, people who owned silver for industrial purposes or jewelry purposes didn't panic. They held small amounts for specific reasons, not for investment return. When crisis came, they held. When prices spiked, they held. When prices fell, they held. They didn't make money, but they didn't lose money either. They had silver for silver's sake, not for wealth multiplication. Second approach, people who dollar cost average into precious metals over years, buying small amounts regularly. Not lumping in during crisis, had much better outcomes. They bought during low periods and high periods, which averaged out their cost basis. They weren't trying to time the market, they were building a small hedge over time. Third approach, people who bought during previous crashes and held for decades did very well. If you bought gold or silver in 1975 at $3 an ounce and held it for 40 years, you made money. The people who did well weren't trying to get rich fast. They were trying to have something that wasn't currency. Fourth approach, people who recognized the pattern and didn't participate at all. They just stayed in diversified investments, boring index funds, real estate, business investments. They did better than people who panic bought silver at peaks. Not as exciting. No I told you so stories to tell. But they kept their wealth. Here's the trade-off. Real estate is illiquid. You can't sell quickly if you need to. Stocks are volatile. You watch them fluctuate. Boring index funds are boring. But if you're wrong about timing, you don't lose 70%. Silver is attractive specifically because of the crisis narrative. The story that when everything falls apart, silver is the answer. And there's historical precedent for that. It's real. But historical precedent isn't a guarantee of future results. And the pattern shows that even when the historical precedent is true, even when crisis does come, the people who try to time it and leverage into it often lose money. The people who already own silver before the crisis, who aren't trying to get rich, who aren't using leverage, they're fine. So here's the story, distilled. In 1979 and 80, currency crisis was real. Dollar devaluation was real. Inflation was real. The Hunt's concern wasn't paranoid. It was based on legitimate economic threats. They responded rationally by buying the thing history said would protect them. They were just wrong about timing. And being wrong cost them 80% of their net worth. Thousands of regular people did the same thing on a smaller scale. They thought they were protecting themselves. They lost money instead. In 2008 and 11, the same cycle happened again. New generation, same logic, different outcome than they expected, but same pattern. Right now, in 2024, the cycle is happening again. Silver is up. There's a narrative about inflation, about currency collapse, about inflation. People are buying. Content creators are talking about $50 silver. The pattern is repeating. Will silver go higher? Maybe. Maybe it won't. I don't know. You don't know. And anyone who tells you they know for certain is selling something, whether it's their newsletter, their credibility, their YouTube channel, or silver itself. What we do know is history. We know that this same conversation has happened before. We know how it ended last time. We know the pattern. Understanding this isn't about whether silver is good or bad. It's about understanding a human pattern that repeats. When we're scared, we look for solutions. We find historical examples of things that worked before. We tell ourselves, this time, I'll get in early. We expect exponential gains. We use leverage to increase our position. When the crisis eases, or when the market moves against us, our safe haven becomes a burden. We're forced to sell. Everyone holding the same thing needs to sell at the same time. Supply overwhelms demand. Prices fall, each generation forgets. They think they've figured out something new. They think they understand something their parents didn't. But the pattern is old. It's not new. It's not clever. It's human. The people who did well in silver over decades didn't get there by panic buying during crisis. They got there by thinking clearly when everyone else was panicked, by not using leverage, by not expecting overnight explosions, by understanding that safe haven means something doesn't disappear. Not that it makes you rich. Your parents felt the same anxiety in 1979 that people feel in 2024. The circumstances are different. The underlying pattern is the same. Understanding that pattern doesn't tell you what to do, but it might help you think more clearly about what you're actually trying to protect.